All right, so here's something that'll make you rethink everything you know about building a business empire. We're talking about a company that in 1990 didn't exist, not even as a concept. And yet, by the time the calendar flipped to the new millennium, this same phantom organization had somehow clawed its way to becoming the third largest agricultural equipment manufacturer on planet Earth. No revolutionary patents, no groundbreaking inventions, no brilliant engineer tinkering in a garage somewhere. Just acquisitions. Lots and lots of acquisitions. This is the story of AGCO Corporation. And if you've never heard of them, well, you've definitely heard of the brands they swallowed whole. Let's rewind to 1990. Deutz-Allis, a German-American tractor joint venture, was bleeding money. The parent company, Klockner-Humboldt-Deutz AG, had poured resources into the North American market and watched them evaporate like morning dew on an Iowa cornfield. They wanted out, desperately. Enter Robert J. Ratliff, a management team member who'd been watching this slow-motion train wreck from the inside. Ratliff wasn't an engineer, he wasn't a farmer. He was a businessman who saw an opportunity in the wreckage. On June 13, 1990, Ratliff and a small team executed a management buyout of Deutz-Allis for roughly $52 million. They renamed it AGCO, short for Allis Gleaner Corporation, honoring the heritage of two brands already in the portfolio, Allis Chalmers Tractors and Gleaner Combines. The company's headquarters? Duluth, Georgia, not exactly the heartland of agriculture, but that detail would become oddly fitting for what AGCO would become, a corporate entity that existed more on spreadsheets than in fields. Now, here's where it gets interesting. AGCO didn't try to out-engineer John Deere or out-manufacture Case IH. They couldn't. AGCO had inherited aging designs, limited production capacity, and a dealer network that was, let's say, skeptical. So, Ratliff did something different. Something that sounds almost too simple to work. He started buying other people's tractor companies. Lots of them. In 1991, barely a year after formation, AGCO acquired the White tractor line from Allied Products Corporation. White had been around since the 1960s, assembling tractors from various components and painting them, well, white. The brand had a loyal following, especially in certain regions. AGCO now had two product lines. Then came Heston Corporation in 1991, a hay and forage equipment maker. Then Deutzer's Argentine operations. Then you get the idea. But the real shockwave hit in 1994. That's when AGCO purchased Massey Ferguson from Verity Corporation for approximately $328 million. Massey Ferguson. Let that name sit for a moment. This was, and still is, one of the most recognized agricultural brands on Earth. A company with roots stretching back to Daniel Massey's workshop in Newcastle, Ontario in 1847. A brand that had pioneered the self-propelled combine, that had sold tractors on every continent, that had become synonymous with reliable farm machinery from Scotland to South Africa to Saskatchewan. And now Massey Ferguson was owned by a company that was 4 years old. The acquisition fundamentally changed AGCO's trajectory. Overnight, they gained access to manufacturing facilities in France, Germany, Brazil, and the United Kingdom. They inherited dealer networks spanning 6 continents. They acquired engineering teams that actually knew how to design tractors. Massey Ferguson wasn't just a brand, it was infrastructure. It was credibility. It was, frankly, everything AGCO had been lacking. Critics were skeptical. How could a startup absorb a heritage brand without destroying what made it valuable? Ratliff's answer was deceptively clever. Don't. AGCO adopted a multi-brand strategy. Instead of forcing Massey Ferguson dealers to also sell Allis or White tractors, each brand retained its identity, its dealer network, its loyal customer base. Farmers who'd bought Massey Ferguson tractors for generations could keep buying Massey Ferguson tractors. The only difference was the name on the corporate checks. This wasn't revolutionary in consumer goods. Procter & Gamble had been doing it for decades with soap and toothpaste. But in agriculture, where brand loyalty ran deeper than family bloodlines, it was almost heretical. John Deere painted everything green and gold and made sure you knew it. Case IH unified under one identity. AGCO said, nah, let's be a portfolio. And then they kept shopping. In 1995, AGCO bought the agricultural equipment division of McConnell Manufacturing, which included the farmhand line. In 1996, they acquired Western Combine Corporation. In 1997, they purchased the remaining assets of Deutz Agricultural Equipment in North America and gained full rights to the Deutz Fahr brand globally through a licensing agreement that eventually led to full ownership. By the late 1990s, AGCO's portfolio read like a who's who of agricultural heritage. Massey Ferguson, Fendt, Valtra, Challenger, wait, we'll get to Challenger in a minute, and a dozen smaller brands catering to regional markets. They weren't inventing new technology, they were just collecting it, curating it even. Each acquisition brought patents, production lines, engineering talent, and most importantly, market share. But here's the thing that kept Wall Street analysts up at night: integration. When you buy a company, you inherit its debts, its inefficiencies, its outdated production methods, its bloated middle management. Most acquisitions fail during integration. AGCO had bought more than 20 companies in less than a decade. The odds of smooth operation were, let's say, not great. Yet somehow it worked. Mostly. AGCO's strategy relied on operational independence at the brand level, but financial and strategic oversight at the corporate level. Fendt engineers in Beauvais, France, didn't answer to Gleaner combine designers in Kansas, but both reported production efficiency and profitability to Duluth. If a factory wasn't hitting targets, corporate stepped in. If a product line wasn't selling, it got cut. Sentiment took a back seat to spreadsheets. Which brings us to the elephant in the field. Did AGCO actually contribute anything to agricultural technology, or were they just really good at buying other people's homework? The answer is complicated. By the year 2000, AGCO hadn't invented precision agriculture. They didn't pioneer GPS guidance systems or variable rate technology. They didn't develop the hydrostatic transmission or the articulated tractor chassis. Those innovations came from the brands they acquired, brands that had engineering legacies stretching back decades. But what AGCO did do was consolidate production, eliminate redundancy, and scale distribution in ways those independent brands never could have achieved alone. Take the Fendt Vario transmission, for example. Fendt, a German manufacturer AGCO acquired in 1997, had developed a continuously variable transmission for tractors that was legitimately revolutionary: smooth, fuel-efficient, operator-friendly. But Fendt was a relatively small player. Under AGCO's ownership, the Vario transmission became a flagship technology marketed across multiple continents. AGCO didn't invent it, but they sure as hell made sure the world knew about it. That's the AGCO playbook in a nutshell. Find great engineering, buy the company that did it, and leverage global scale to maximize its reach. Not exactly poetic, but undeniably effective. So, as the 1990s closed, AGCO had transformed from a management buyout of a failing joint venture into a multi-billion-dollar agricultural conglomerate, with brands sold in more than 140 countries. They'd done it without inventing a single tractor from scratch. And they were just getting started. Now, if you thought AGCO was done shopping after swallowing Massey Ferguson, you'd be very wrong. The late 1990s and early 2000s saw AGCO execute what can only be described as a feeding frenzy. But this wasn't random. Every acquisition had a strategic angle, filling gaps in geography, product line, or technological capability. And some of these purchases were, frankly, audacious. Let's talk about Fendt. In 1997, AGCO paid approximately $300 million to acquire this Bavarian tractor maker from the Xaver Fendt family. Fendt wasn't struggling, far from it. They were profitable, respected, and beloved in Europe for producing some of the most technologically advanced tractors on the market. Fendt tractors were the Mercedes-Benz of agriculture. Premium priced, meticulously engineered, and backed by a dealer network that treated customers like royalty. Why would Fendt sell? Age, mostly. The Fendt family, which had owned the company since its founding in 1930, lacked a clear succession plan. Rather than risk the brand's legacy with an uncertain transition, they sold to AGCO. The deal came with conditions, though. Fendt's headquarters would remain in Markdorperdorf, Germany. Production would stay local. The engineering team would retain autonomy. AGCO agreed. They weren't buying Fendt to gut it. They were buying Fendt because it was already excellent. And excellent it was. The Fendt Vario transmission, introduced in 1995, had been the first stepless transmission in a production tractor. It allowed infinite variability between 0 and maximum speed without gear changes, delivering smoother operation and better fuel efficiency. Farmers loved it. Competitors scrambled to develop their own versions. Under AGCO's ownership, Vario technology spread to other brands in the portfolio, and Fendt's reputation as an innovation leader only grew. Then, in 2004, AGCO made a move that shocked the industry. They purchased the Challenger agricultural equipment business from Caterpillar, Inc. for around $430 million. Challenger, as in tracked tractors, as in machines that looked like they belonged on a construction site, but were actually tilling fields with rubber tracks instead of wheels. Caterpillar had entered agriculture in the 1980s with the Challenger 65, the world's first rubber-tracked agricultural tractor. The concept was brilliant. Tracks distributed weight more evenly than wheels, reducing soil compaction while improving traction. For large-scale farming operations in tough soil conditions, Challengers were game changers. But Caterpillar, despite its engineering prowess, struggled to build a robust agricultural dealer network. Selling bulldozers and selling tractors required different relationships, different service capabilities, different mindsets. Cat's ag dealers were often the same dealers selling construction equipment, and farmers didn't always feel prioritized. AGC saw opportunity. They had dealer networks. They understood agricultural customers. What they didn't have was a strong presence in the high-horsepower tracked tractor segment. The Challenger acquisition gave them instant credibility in that space. AGCO retained the Challenger brand identity, maintained production at the facilities in DeKalb, Illinois, and integrated Challenger into their multi-brand strategy. Farmers who wanted a yellow tracked tractor could still get one. It just said AGCO on the invoice now. But acquisitions weren't the only way AGCO expanded. They also formed strategic partnerships and joint ventures. In 2004, they entered a joint venture with Valtra, a Finnish tractor manufacturer with strong market presence in Scandinavia and South America. By 2004, AGCO owned Valtra outright. Valtra's expertise in cold weather engineering and forestry applications complemented AGCO's portfolio, especially in markets where Massey Ferguson or Fendt weren't dominant. Now, let's address the obvious question. How does a company finance this kind of expansion? AGCO went public in 1992, listing on the New York Stock Exchange under the ticker symbol AGCO. Going public provided capital for acquisitions, but it also meant answering to shareholders who wanted returns. This created tension. Shareholders wanted profitability, growth, efficiency, but integrating acquired companies, especially ones with distinct cultures and engineering philosophies, took time and money. AGCO's solution was brutal simplicity: cut costs wherever possible. They consolidated redundant production facilities, they standardized components across brands where they could, they renegotiated supplier contracts with the leverage of $1 billion purchasing volume. If a factory was underperforming, they shut it down or sold it off. Sentimentality didn't enter the equation. The multi-brand strategy, while clever, also created internal competition. AGCO dealers in the same region might sell Massey Ferguson, Challenger, and Fendt tractors, all AGCO products, all competing for the same customer's dollar. This sounds like a recipe for disaster, but AGCO argued it was a feature, not a bug. Different brands appealed to different customer segments. A farmer loyal to Massey Ferguson for decades wasn't going suddenly to buy a Fendt just because they were both AGCO brands. But if that farmer's neighbor preferred Fendt, AGCO captured that sale too. The company's market share increased, even if individual brand shares fluctuated. By the mid-2000s, AGCO's portfolio included Massey Ferguson, the global workhorse sold in over 140 countries, Fendt, the premium European brand expanding into North America, Challenger, high-horsepower tracked tractors for large-scale operations, Valtra, strong in Northern Europe and South America, White, Gleaner, Heston, regional brands with loyal followings, plus about a dozen smaller brands and joint ventures in markets like India, China, and Sub-Saharan Africa. Each brand maintained distinct product lines, but increasingly they shared components. A Massey Ferguson transmission might be identical to one in a Valtra. A Challenger GPS system might be the same unit installed in a Fendt. This parts sharing reduced costs and simplified service, even if it blurred the lines between brands. But here's where it gets messy: technology. By the 2010s, agriculture was undergoing a digital revolution. Precision farming, autonomous tractors, data-driven decision-making. These weren't futuristic concepts anymore. They were competitive necessities. And AGCO, for all its acquisition prowess, was behind. John Deere had invested billions in proprietary precision agriculture systems. Case IH had integrated advanced telematics into their equipment. Farmers were demanding connectivity, integration, software support. AGCO had great mechanical engineering across their brands, but software development? Not their strength. So AGCO did what AGCO does best. They went shopping. But this time, they weren't buying tractor companies. They were buying technology startups. In 2017, AGCO acquired Precision Planting, a company specializing in planter technology and precision agriculture solutions. In 2018, they purchased Weevil Corporation and JCA Technologies, companies focused on grain handling and autonomous systems. They partnered with tech firms to integrate GPS guidance, variable rate application systems, and farm management software into their equipment. These acquisitions were different from the Massey Ferguson or Fendt deals. They weren't buying established brands with decades of heritage. They were buying expertise, intellectual property, and most importantly, speed. Developing precision agriculture systems in-house would take years. Buying companies that already had functioning products got AGCO into the game immediately. But integration proved harder than expected. Farmers complained about software bugs, incompatible systems, and poor tech support. AGCO's dealer networks, which excelled at repairing mechanical systems, struggled with software diagnostics. Engineers at acquired tech companies clashed with the agricultural engineering teams over priorities and design philosophy. The transition from being a mechanical equipment manufacturer to a technology-integrated solutions provider wasn't smooth. Still, by 2020, AGCO had grown into a $9 billion company with global operations, selling equipment in more than 140 countries through 3,100 independent dealers and distributors. They'd become the world's third-largest agricultural equipment manufacturer, trailing only John Deere and CNH Industrial. Not bad for a company that started as a buyout of a failing joint venture. But they still hadn't invented anything.
So let's address the elephant that's been sitting in this field the whole time. What does it actually mean to be a company built entirely on acquisitions? And more pointedly, does it matter if AGCO never invented a tractor from scratch, as long as they keep farmers supplied with machines that work? Philosophically, this gets interesting. In most industries, we celebrate inventors and innovators. Thomas Edison, Henry Ford, Steve Jobs. These are the names that echo through history because they created something new, something that didn't exist before. But AGCO is the anti-Edison. They're the corporate equivalent of a museum curator. They didn't paint the masterpieces, but they preserved them, displayed them, and made sure people could access them. Take Massey Ferguson's MF35, introduced in 1957, decades before AGCO existed. This tractor became one of the best-selling agricultural machines in history, with over 500,000 units produced by 1964. It was exported to over 150 countries and became the backbone of mechanized farming in post-war Europe, Africa, and South America. Farmers in places like Kenya and Argentina still run MF35s today. That's heritage. That's engineering legacy. AGCO didn't build the MF35, but when they bought Massey Ferguson in 1994, they inherited responsibility for maintaining parts availability, service documentation, and dealer support for thousands of these machines still in operation worldwide. That's not glamorous, it doesn't win engineering awards, but it matters to the farmer in rural Tanzania whose 1960s MF35 is still his primary tillage tractor and who needs replacement hydraulic seals that fit exactly. AGCO's business model relies on this kind of long-tail support. They maintain manufacturing capability and parts inventories for equipment that's decades old, across dozens of brands, each with unique specifications. This is logistically nightmarish and financially questionable. There's not much profit in selling a $14 gasket for a 40-year-old combine, but it sustains dealer relationships and brand loyalty. A farmer who knows they can still get parts for their grandfather's Massey Ferguson is more likely to buy a new Massey Ferguson when it's time to upgrade. Now, contrast this with John Deere's approach. John Deere is vertically integrated. They design, engineer, manufacture, and sell their equipment under one brand with one identity. They control the entire value chain, from casting engine blocks to writing the software that controls precision planting. This gives them incredible quality control and brand consistency. When you buy a John Deere tractor, you know exactly what you're getting, and it'll be green. But vertical integration has limitations. If John Deere's engineering team makes a design mistake, it affects the entire product line. If their manufacturing process has inefficiencies, it impacts every unit produced. There's less flexibility, less regional adaptation. A John Deere built for Iowa might not be ideal for rural India, but Deere's scale makes it expensive to customize for smaller markets. AGCO's multi-brand strategy sidesteps this. Massey Ferguson can design tractors optimized for African and South American markets with specific features, like high ground clearance and simplified maintenance. Fendt can focus on the premium European segment with advanced technology and luxury cabs. Challenger can prioritize high-horsepower tracked machines for North American megafarms. Each brand operates semi-independently, tailoring products to their markets, while AGCO handles finance, corporate strategy, and parts consolidation behind the scenes. This creates inefficiency, critics argue. Why have 3 different engineering teams designing 3 different 150-horsepower tractors when one team could design one tractor and badge it differently? AGCO's answer is because farmers are brand loyal, and forcing them to abandon heritage brands for corporate efficiency destroys value. A Fendt farmer doesn't want a rebadged Massey Ferguson. They want a Fendt. AGCO's job is to give them that Fendt while quietly sharing as many components as possible to keep costs down. And that's the uncomfortable truth AGCO operates under. Most of the brands they acquired were struggling financially when AGCO bought them. Massey Ferguson had been through bankruptcy. Deutz-Allis was bleeding cash. White had changed ownership multiple times. These weren't thriving businesses AGCO poached. They were companies on life support that AGCO resuscitated through capital infusion and operational restructuring. But resuscitation comes with compromises. AGCO closed factories, cut product lines, and laid off workers. They discontinued models that weren't profitable, even if they were beloved by a small customer base. They consolidated regional brands into larger entities. The AGCO-Allis brand, for example, which had carried the Allis-Chalmers legacy, was quietly phased out in 2001. Production stopped. Dealers were transitioned to other AGCO brands. The name just disappeared. For farmers who'd run Allis-Chalmers tractors for generations, this was heartbreaking. AGCO didn't care. The brand wasn't generating sufficient returns, and maintaining it diverted resources from more profitable lines. Cold calculus won. This tension between heritage and profitability defines AGCO's entire existence. They market themselves as stewards of agricultural tradition, preserving iconic brands like Massey Ferguson and Fendt. But they're also a publicly traded corporation with shareholders demanding quarterly earnings growth. When those two priorities conflict, profitability wins. Every time. Yet, somehow, it works. AGCO's revenue has grown almost every year since its founding. They've expanded into emerging markets like India and sub-Saharan Africa, where demand for agricultural mechanization is surging. They've adapted to the digital agriculture revolution, albeit later than competitors, by acquiring tech companies and integrating precision farming systems into their equipment. By 2019, AGCO had reached $9.04 billion in revenue with approximately 21,000 employees worldwide. They operated manufacturing facilities in more than a dozen countries and sold equipment through 3,100 independent dealers. Their stock price had grown from around $10 per share in the early 2000s to over $70 per share by 2020, a 7-fold increase that made early investors very happy. But there's a darker side to this story, one that doesn't get talked about much in the corporate success narrative: dealer relationships. AGCO's multi-brand strategy depends entirely on independent dealers who sell and service their equipment. These dealers invest millions in parts inventory, service training, and facility infrastructure to support AGCO brands. But because AGCO owns multiple brands, dealers often compete against each other, even if they're all AGCO products. A Massey Ferguson dealer and a Fendt dealer in the same region are technically both AGCO dealers, but they're rivals. If the Fendt dealer wins a sale, the Massey Ferguson dealer loses. AGCO doesn't care which brand wins because they profit either way, but dealers care. A lot. This creates resentment. Dealers feel like AGCO prioritizes corporate profitability over dealer success. And when AGCO introduces a new brand into a region, say bringing Fendt into North America, where Massey Ferguson and Challenger already have established dealer networks, existing dealers feel undercut. Why invest in expanding their Massey Ferguson sales if AGCO is just going to introduce Fendt as a competitor? AGCO's answer is again market segmentation. Massey Ferguson and Fendt target different customer segments, so they're not really competing. But try telling that to a dealer who just lost a sale to another AGCO brand. The frustration is real, and it's fueled dealer attrition. Some dealers have dropped AGCO brands entirely and switched to competitors. Still, AGCO soldiers on, because at the end of the day, their model works often enough to keep growing. They're not the biggest, not the most innovative, not the most beloved, but they're consistent, diversified, and pragmatic. They'll never be John Deere, but they don't need to be.
Let's shift gears now because we need to talk about what happened when the agricultural equipment industry hit its next major inflection point, the rise of smart farming. And here's where AGC's strategy of buying rather than building started showing serious cracks. Precision agriculture isn't new. Farmers have been using yield monitors, GPS guidance, and variable rate application systems since the 1990s. But around 2010, the industry entered a new phase, data-driven farming. It wasn't enough to have GPS steering anymore. Now, tractors needed to collect soil data, communicate with planters and sprayers, upload information to cloud-based farm management platforms, and integrate with third-party software used by agronomists and crop consultants. This was a different kind of challenge. Mechanical engineering, AGC had that covered across their brands. Hydraulics, transmissions, engine performance, they'd inherited decades of expertise through acquisitions. But software development, building platforms that could handle terabytes of farm data, interface with equipment from multiple manufacturers, and provide actionable insights to farmers, that wasn't in the DNA of any brand AGC had acquired. John Deere saw this coming. They'd been investing in precision agriculture since the 1990s, and by 2010, they had a unified software ecosystem called John Deere Operations Center. It was proprietary, integrated, and crucially, it worked. Farmers could manage their entire operation through Deere's platform. Deere equipment communicated seamlessly. Data flowed from field to office to agronomist without glitches. AGC, meanwhile, had a problem. Each of their brands had developed its own precision agriculture systems independently. Massey Ferguson had one approach, Fendt had another, Challenger used different hardware. Nothing talked to each other. A farmer running both a Massey Ferguson tractor and a Challenger sprayer couldn't integrate data between the two machines without manual workarounds. This was not ideal. AGC's initial response was to develop Fuse Technologies, their own precision agriculture brand launched in 2012. Fuse was supposed to be the connective tissue, a unified platform that could work across all AGC brands and integrate with third-party equipment. The concept was sound, the execution, rough. Fuse systems were buggy. Farmers complained about connectivity issues, lost data, and interfaces that were clunky compared to Deere's polished software. Dealers struggled to provide tech support because the systems were complex and the training materials were inadequate. And because Fuse was trying to integrate with equipment from multiple brands, each with different electronic architectures developed independently, compatibility problems were constant. AGC responded by doing what they do best, acquiring their way out of the problem. Between 2015 and 2020, they purchased several precision agriculture technology companies. Precision Planting in 2017, a leading provider of planter technology and precision agriculture solutions, Precision Planting had developed systems that optimized seed placement, downforce, and spacing. Farmers loved their products. AGC paid $190 million. Vario Systems AgTech assets in 2018. Vario had developed autonomous systems and machine monitoring technology. AGC integrated these into their Fuse platform. JCA Technologies and Weevil Corporation in 2018. Both companies specialized in grain handling and storage monitoring. These acquisitions expanded AGC's offerings beyond field equipment into post-harvest operations. Trimble in 2021. This was a big one. AGC entered a joint venture with Trimble, a leader in GPS and precision agriculture technology, to form a new company focused on developing advanced farming solutions. The deal gave AGC access to Trimble's established technology and software expertise while maintaining brand independence. On paper, these acquisitions addressed AGC's technology gap. In practice, integration remained messy. Each acquired company brought its own software platforms, hardware systems, and engineering cultures. Merging them into a cohesive precision agriculture ecosystem was like trying to combine 5 different jigsaw puzzles into one picture. Pieces didn't fit, colors clashed, frustration mounted. But AGC kept pushing. By 2020, they'd invested over $1 billion in precision agriculture technology and software development. They launched updates to Fuse that improved stability and added features. They trained dealers on tech support. They hired software engineers, lots of them, to complement their mechanical engineering teams. And slowly, painfully, it started working. Not perfectly, not as smoothly as a fully integrated John Deere operation, but functional enough that farmers began adopting AGC precision agriculture systems at scale. By 2022, AGC reported that more than 50% of their new equipment sales included some level of precision agriculture technology. Now let's zoom out and look at the broader competitive landscape, because AGC wasn't just battling John Deere and Case IH for market share. They were also facing a new threat: technology companies entering agriculture. Companies like Raven Industries, Topcon, and even tech giants like IBM and Microsoft were developing agricultural technology platforms. These weren't traditional manufacturers. They were software and data companies who saw farming as the next digital frontier. Farmers could, in theory, buy equipment from AGC but use a completely different company's precision agriculture platform. This terrified traditional manufacturers. If farmers started viewing tractors as commodity hardware, just engines and wheels that could run anyone's software, brand loyalty would evaporate. The real value would shift to whoever controlled the software ecosystem. John Deere responded by locking down their systems, making it difficult for third-party software to interface with Deere equipment. This sparked the right-to-repair movement, with farmers arguing they should be able to service and modify their own equipment without manufacturer restrictions. AGC took a different approach. They positioned Fuse as an open platform that could integrate with third-party systems. A farmer could use AGC equipment with non-AGC software if they wanted. This was marketed as farmer-friendly and pro-choice, though cynics noted it also reflected AGC's weaker position. They couldn't force a closed ecosystem because their software wasn't dominant enough to justify it. But here's where AGC's multi-brand strategy became an advantage. Because they owned multiple brands targeting different market segments, they could experiment with different technology approaches. Fendt could push cutting-edge autonomous systems in Europe. Massey Ferguson could offer simpler, more affordable precision agriculture options in developing markets. Challenger could integrate advanced telematics for large-scale commercial farms. Each brand served as a testing ground, and successful features could be rolled out across the portfolio. By the early 2020s, AGC had stabilized their technology offerings. They weren't leading the industry in innovation, but they'd closed the gap. Farmers could buy AGC equipment confident that it included modern precision agriculture capabilities, even if it wasn't quite as seamless as a fully integrated John Deere operation. And then COVID-19 hit. The pandemic disrupted global supply chains in ways the agricultural equipment industry had never experienced. Semiconductor shortages halted production, shipping delays stranded components at ports, factories shut down due to outbreaks among workers. Demand for farm equipment surged as commodity prices rose, but manufacturers couldn't build machines fast enough to meet orders. AGC, with its globally distributed manufacturing network across North America, Europe, South America, and Asia, faced unique challenges. Coordinating production when factories on 3 continents were operating under different lockdown restrictions was a logistical nightmare. Parts manufactured in Germany couldn't reach assembly plants in Brazil.
Engines built in the UK sat waiting for transmissions manufactured in Finland. The strategy worked, mostly. AGC's revenue in 2021 reached $11.1 billion, a record high driven by strong commodity prices and pent-up equipment demand. Farmers who'd delayed purchases during the early pandemic rushed to buy new tractors and combines. AGC's stock price soared past $150 per share. But the supply chain issues exposed a fundamental tension in AGC's model. Their multi-brand, globally distributed strategy relied on efficient logistics. When logistics broke down, the entire system strained. Dealers couldn't get parts, production lines stalled, customers faced delays of months, sometimes over a year for new equipment. Frustrated farmers turned to competitors, and some didn't come back.
All right, so where does that leave us? Here we are in 2024, and AGCO is reporting revenues around $12.7 billion, employing roughly 23,000 people and selling equipment in more than 140 countries through thousands of dealers. By any measure, this is a successful company. Third largest agricultural equipment manufacturer on Earth, steady revenue growth, strong brand portfolio, global reach. And yet, they still haven't invented a tractor. Not really. Not from scratch. Not with a clean sheet of paper and an engineering team building something genuinely new. Every major product line in AGCO's portfolio traces back to engineering done by companies that existed before AGCO was even a concept. The Massey Ferguson tractors sold today, direct descendants of designs developed in the 1950s and 60s. Fendt Vario transmissions, invented by Fendt engineers in the 1990s. Challenger tracked tractors, pioneered by Caterpillar in the 1980s. AGCO's contribution has been refinement, not invention. They've improved existing designs, integrated new technology, and scaled production. They've made incremental advances in fuel efficiency, operator comfort, and precision agriculture integration. But breakthrough innovation, revolutionary new concepts that redefine what a tractor can be, that's not what AGCO does. And honestly, maybe that's okay. Here's the thing. The agricultural equipment industry doesn't need 5 companies all trying to reinvent the tractor. Farmers need reliable machines that work when it's planting season, that can be repaired quickly when they break, and that hold their value for resale. They need dealers who understand their operations and can provide parts and service. They need equipment that's compatible with the infrastructure they've already invested in. AGCO provides all of that across multiple brands, multiple price points, and multiple regions. A farmer in France can buy a premium Fendt with every bell and whistle. A farmer in Kenya can buy a simpler, more affordable Massey Ferguson, optimized for rough terrain and basic maintenance. A large commercial operation in Kansas can run Challenger tracked tractors with advanced telematics. AGCO serves all these markets simultaneously because they're not constrained by a single brand identity or engineering philosophy. This is the genius of the multi-brand strategy, even if it's not glamorous. AGCO operates as an agricultural equipment holding company, curating brands like an art museum curates paintings. They didn't create the masterpieces, but they preserve them, display them, and make them accessible. But there's a limit to how far this model can stretch. As the industry shifts towards autonomous equipment, electric powertrains, and AI-driven farm management, the old playbook of acquiring heritage brands and refining their mechanical designs becomes less relevant. Software and data are now as important as hydraulics and horsepower, and you can't just buy a tech startup and bolt it onto a 1960s tractor platform. The integration has to be fundamental, from the ground up. AGCO recognizes this. Their investments in precision agriculture, their partnership with Trimble, their development of fuse technologies, these are attempts to evolve beyond just being a portfolio manager of mechanical tractor brands. They're trying to become a technology company that also makes tractors, rather than a tractor company that also uses some technology. Whether they'll succeed is an open question. John Deere has a decade-plus head start in building integrated digital ecosystems. Case IH and CNH Industrial have deeper engineering resources. New entrants like Monarch Tractor and companies backed by venture capital are developing electric, autonomous equipment with software-first design philosophies.
AGCO is caught between heritage and future, trying to modernize brands built on mechanical excellence for an era that increasingly values digital intelligence. But AGCO has survived worse. They started as a failing joint venture that nobody wanted. They grew by acquiring struggling brands that couldn't survive independently. They've navigated recessions, supply chain crises, technological disruption, and intense competition. They're still here, still growing, still profitable. And maybe that's the real story. AGCO Corporation isn't about invention. It's about survival and adaptation. It's about recognizing that farmers around the world have different needs, different budgets, different priorities, and providing options that serve all of them. It's about preserving brands that have earned loyalty over generations, while pragmatically sharing components and cutting costs where customers won't notice. Is this model sustainable long-term? Hard to say. The industry is consolidating, smaller brands are disappearing, technology requirements are increasing costs and complexity, farmers are demanding more for less, margins are tightening. The next decade will test whether AGCO's multi-brand portfolio strategy can survive when every brand needs to offer cutting-edge autonomous capabilities and AI-driven precision agriculture at competitive prices. But for now, AGCO stands as proof that you don't need to invent something to build an empire. You just need to recognize value, acquire it, preserve it, and scale it. You need to understand that farmers care more about whether their tractor starts on a cold morning than whether the company that built it invented the transmission from scratch. AGCO didn't invent anything, but they made sure millions of farmers around the world had access to the inventions of others. And in a world where feeding billions of people depends on reliable agricultural equipment, maybe that's enough. So, the next time you see a red Massey Ferguson tractor, a green Fendt, or a yellow Challenger working a field, remember, the company that sold it didn't invent it. They just made sure it was still available when it was needed.